Hey everyone, welcome in to another daily editorial here on the KE Report. I'm chatting with Craig Hemke. We're going to be recapping the precious metals prices. Gold at $25.50, silver at around $30. Going to get Craig's thoughts on the CoT reports, the commitment of trader reports, as well as probably a couple comments on the underlying precious metals equities. Craig Hemke is the founder and editor of TF Metals Report. I will post a link to that website in the show notes. Craig, let's start off with the commitment of traders reports. It was recently that we were talking about hedge funds broadly being the most bearish in commodities since we've seen since 2011. But let's focus on the gold and silver CoT reports. Any major changes, any overall comment that you can make because you follow these so closely at where the positioning stands right now?
Well, hi, Corey. Yeah, it's a rather interesting point here in late August. Yeah, I'm glad you brought up that report from a couple of weeks ago about, I think it was a basket of 20 commodities as measured by these commitment of trades reports, and that the hedge funds were net short across the basket for the first time since I think if I remember right from looking at it, early 2016 and early 2019, and maybe the most short since 2011, like you said. That gold and silver, I'm sure, are in that basket, but there are really large hedge fund short positions in things like crude oil, grains, and so that kind of weighting the whole thing. But as a contrary indicator, people remember what happened in early 2016 for the first 8 or 9 months of the year. People remember what happened through 2019 and 2020. And so it's a very good indicator. Now, to gold and silver specifically, and for people that don't know, these commitment of traders reports are surveyed every Tuesday at the COMEX close. And then 74 hours later, that information gets released at 3:30 Eastern time on Friday. So they're not really trading tools. The only really value that you can take out of them is if you are able to look at them on a historical basis to correlate with price. Say, okay, well, the last time the hedge funds or the large speculators had a net long position of this magnitude, what happened following that? That allows you to use these things to, again, not trade, but maybe pick up on kind of the shorter to intermediate term trend. That said, gold, at least as of last Tuesday, in the broad category of what we'll call hedge funds and other large speculators, in that category, they are net long, approaching 300,000 contracts. Now, I've seen that go all the way to about 350 or 360,000, but it's more typical to have it around 180 to 200,000. So it gives you some idea how stretched that is. Now, silver's not quite in the same boat. But in silver, that speculator category has a very small gross short position. And it's very small in gold too. That's why that net position is so large. And so without trying to confuse everybody, the main thing here that's noteworthy in the current structure of the COMEX gold and silver markets is a very small, relatively speaking, speculator short position. Now, you'd rather have that be a larger number because in an up move, speculators, when they're short, are apt to cover. And a lot of these hedge funds and trading funds in an up move will flip from having been short to going long. Well, that's actually two buys, Corey. You got to buy back your short position, then you got to go buy a new long position. So when there's a relatively good-sized short position in the metals from the speculators, a big move up or a start of a move up can really begin to accelerate as that short covering and new buying comes in. That's kind of why the metals are lagging a little bit here, is we're waiting for more longs to come in, really, rather than just short covering. You recall back that first week of March when gold broke out above 2,100, it added $100 in a week and eventually went to 2,450. Well, last week, after breaking out to new highs above 2,520, we've added $30. Just not quite the same, and a lot of that is due to this. Let's put it this way: those who are going to buy have bought, and so we're waiting for them to either buy more or new parties to come in and buy more, and that's what it takes: more buyers than sellers.
Yes, it does, and that's why we keep saying we need some of other buyers to come in rather than those just more focused on the metals. Craig, any correlation that you can draw to some of the volumes in something like GLD or SLV. These are the ETFs that follow the underlying gold, silver prices. Their volumes did perk up a few months ago, but now we're right back at these generally lower volume levels.
Yeah, I don't know if that kind of retail demand for those ETFs has much impact on price. I know some folks like to follow the total amount that's in their alleged inventory, whether that correlates with price as well. But I don't know. I guess it's nice to have retail interest in those funds because maybe that spills over or is related to retail interest in the actual shares. But the main driver at this point continues to be global physical demands, especially still ongoing central bank demand. So that's showing itself up in Shanghai and in London. But then this interest from hedge funds and large funds and home office investors that want to want to have exposure to the gold price, and so they're coming in and they're buying contracts, COMEX gold contracts, and that is the driver of price. Again, more buyers and sellers. Silver, again, why is silver lagging? Again, gold is broken out. Silver is not within, I mean, barely within 10% of its highs from last May, and I think that's could relate that to two things. One, again, very small from a historical standpoint, short, speculator short position in silver. So you don't have that, or Ted Butler used to call it rocket fuel of that short covering. The other part, though, too, Corey, is that copper is still down. Copper is really about 20% down, maybe 18% down from its highs still last May. So think of it this way. I know we've talked about this in the past. Gold is up versus its highs from last May, marginally, maybe 3 or 4%. Copper is down about 20% from its highs last May, which kind of catches silver in the middle, down about 10% still from its highs. So we need copper to turn around. We need interest in owning silver in all its forms. We need gold to keep going up. There's a number of things that we need, and that's all part of why silver continues to lag and frustrate.
Yeah, we've heard that, right? It's that industrial component that very well could be holding silver back. But man, silver's been kind of an underperformer to gold through a lot of this move, this now multi-year move if you want to go back a few years. Overall, though, we look around the markets and there's a lot going in favor, you would think, for the precious metals. Rate cuts, they're coming. We all accept that. There's inflation. It's broadly higher than, let's say, before we went through the pandemic. There's still a couple wars going on. You can even say there's U.S. election uncertainty. What else could filter into kind of that push-pull, positive, negative drivers for the precious metals?
Yeah, I don't want to get too caught up in the commitment of trader stuff because it's just kind of I don't even know if it's a primary to secondary thing that you got to keep track of. It's just one of the things. As you were asking me that question, Corey, I'm remembering how back in about February and into March, I remember a couple of discussions with you and Shad as gold was beginning to break out. It had gone to 2,100 in December and then spent about 90 days building up against resistance. And then it finally blasted through 2,100 and it went to 22 and 23 and 24. And in the month of March, while that was happening, silver wasn't doing anything. And I remember, again, like I said, a couple of times talking about how, look, we're not going to 100 to 1 on the gold silver ratio. I mean, I just don't think that we're going to have $2,300 gold and a $23 silver price. And we didn't. I mean, gold went up and then silver rushed to catch up and went from 24 to 33. And I think the same thing kind of holds now. Gold has gone sideways for about 3.5 or 4 months. It has finally broken out and is well into the 2,500s. Silver will, I mean, I don't think silver, if gold's going to 2,650 or 2,700 on the back of the fundamental things that you mentioned, again, I don't think we're going to a 100 to 1 gold silver ratio, and silver is going to be stuck at 27 or 28. So a time will come, regardless of all this commitment of trader stuff that I was talking about, where if gold continues to go up, there will be a rush into silver again. That should break it above 33 and maybe even get it to 35 or 6 as its next target. But for now, again, we're kind of battling late summer doldrums, some dog days. Everybody's waiting to get to September to see what happens, with the next round of economic data and the next Fed meeting. And so we'll just see where we go from here. One last thing, Corey, too. This is the last week of August. I remember we discussed back at the end of July how August typically is a very strong month seasonally. second strongest month of the year after January on average. And lo and behold, we've had a very good month, and the month is going to end on Friday, so we'll be painting the monthly charts. We're going to have a new all-time high monthly close in gold, and that's usually a very good sign for more inflow of funds, more interest in the sector. And so hopefully that'll set us up for a good September.
Man, it's been pretty consistent. Gold has been doing its job. It continues to move higher. Dips continue to be bought. Craig, one other aspect that we haven't really talked about, this data came out, well, at least it was sent to me after our last conversation, and that was monthly flows, money flows into gold ETFs. July was a massive change from what we've seen from the rest of this year, where we saw North American buyers do most of the heavy lifting. We also saw Europe and Asia as net buyers. Again, North America has been that missing component. Not sure if you saw that data or what your takeaway is from at least that news from July, where it was almost global demand that was moving into GLD.
I did not see that data. And again, that's not one that I keep a real close tabs on. I have seen some very interesting charts of silver demand in China and silver demand in India. Famously, when they think the price of gold is getting high, they shift their demand into silver. And so I guess it's not surprising the data that you cite kind of correlates with that. And that's the kind of thing, again, it's not, we need to have buyers, these hedge funds and the like, we need to have buyers of the futures contracts because to me, the futures price is still the tail that wags the spot dog. But underlying that is the physical demand that kind of contains any pullback. You know, if we get into the paper markets, the digital markets pulling back, if the physical demand remains strong, then that tends to really tamp down how far price can fall to the downside because physical buyers start rushing in. So it's nice to have the data, like you said, the ETFs, nice to see the physical demand show up not only at the sovereign side, but global retail, global institutional. And I think that pads the downside while providing a pretty steady upside trend that we should be able to follow through at least the end of the year.
Yeah, well, if anything, man, oh man, that downside has been muted for gold, especially as it has just continued to move higher. Silver has been very much a different story, but hey, it's trying to hold and get back above that 30 level. Hopefully that could provide some more interest into the underlying equities, which have done okay, but broadly still are lagging or at least not providing that leverage that a lot of people are looking for. Craig, always great chatting with you. As I mentioned, I will post a link to TF Metals Report in the show notes. Everyone be sure to click on that link to follow up and keep up to date with Craig. Craig, thanks again for your time.
Always good to talk.